Imagine Sarah, a young professional who's done everything right, built a career, saved for a down payment, and maintained a stellar credit score. She dreams of owning a downtown condo, the reward for her years of discipline. Confident, she applies for a mortgage, certain her high credit score and savings will guarantee approval. Days pass. Then, the email arrives. Her application is declined. Shocked, Sarah searches for answers, but the lender's message is vague and unhelpful. She's left confused and discouraged, wondering how this could happen after following all the rules. This isn't rare. Many people with excellent credit scores are blindsided by mortgage rejections. They focus on that three-digit number, believing it's the golden ticket, only to discover it's not enough. The rejection feels personal, like a judgment on their financial character. But the truth is, lenders look for more than just a high score. A credit score is only one piece of a much larger puzzle. Lenders want to see a story of stability and predictability, not just a snapshot of your finances. They're searching for proof you'll be a reliable borrower for decades, not just today. This is where the real evaluation begins. The rules are more complex than most realize. A high score opens the door, but it doesn't guarantee you'll walk through it. To truly succeed, you need to understand what lenders are really looking for. Let's break down what it takes to earn their trust. The gap between a high credit score and mortgage approval comes down to what we'll call the trust formula. Lenders want more than a number, they want a profile of trust. The trust formula is simple: correct behavior times time, plus diversity. Each pillar tells a different part of your financial story. Lenders use this formula to predict your future reliability, not just your current score. Understanding this shifts your focus from chasing a number to building a trustworthy profile. The right mindset is the first step to taking control of your mortgage journey. The foundation of the trust formula is correct behavior. This means always paying bills on time and keeping credit card balances low. Even one late payment can raise red flags for underwriters, especially in the 2 years before you apply. Lenders want to see low credit utilization, ideally under 10%, not just the standard 30%. They look at both individual cards and your overall usage. Maxed out cards, even if your average is low, can signal risk. The ideal profile: low balances across all accounts month after month. This shows you live within your means and use credit as a tool, not a crutch. Every on-time payment and low balance builds your case. Correct behavior is the non-negotiable starting point for mortgage approval. Time multiplies the impact of your good habits. Lenders want to see a long, consistent track record, not just a few months of positive behavior. The age of your credit file matters. Older is better. Closing old accounts can hurt you by shortening your credit history. Consider 2 applicants with the same score, one with 3 years of history, another with 10. The longer, more consistent record inspires more confidence. A thin file, even with a high score, looks fragile to lenders. Start building credit early and keep your oldest accounts active. Time turns good habits into proven reliability. It's the silent partner that validates your financial character. The third pillar is diversity, your experience with different types of credit. Lenders want to see you can handle both revolving credit, like cards, and installment loans, like car or student loans. Managing only credit cards is one-dimensional. Successfully paying off an installment loan proves you can handle fixed, long-term payments, just like a mortgage. For example, 2 couples with similar scores, one has only credit cards, the other has cards and a paid-off auto loan. The second couple's profile is stronger. Don't take on unnecessary debt just for diversity, but value the loans you do have. If you finance a car, paying it off diligently can help your mortgage profile. Diversity shows you can manage various financial responsibilities. It completes the 3-dimensional picture of trust lenders need. Together, these pillars form the foundation of a strong mortgage application. Beyond the main pillars, underwriters look for hidden patterns, like your credit utilization over time. Paying down balances right before applying isn't enough. Lenders review your monthly balances for the past year or two. If you suddenly drop your utilization, it can look like you're gaming the system. Consistently low balances month after month are far more convincing. This pattern signals genuine financial health, not a temporary fix. Treat utilization as a long-term habit, not a last-minute tactic. Consistency here is a powerful signal of stability. Another pitfall is the thin file or recency problem. Having only 1 or 2 accounts, even if old and perfect, gives lenders little data to assess. Lenders prefer at least 3 to 5 active accounts. Inactive accounts, even if old, don't show current behavior. No recent activity means no proof of your current habits. The solution: use all your accounts, even if just for small purchases, and pay them off monthly. This keeps your file active and robust. You don't need to carry a balance, just show regular, responsible use. A seasoned, active, and diverse file is what lenders want to see. Here's a 3-step plan to make your credit profile irresistible to lenders. First, audit your credit report from all 3 bureaus. Check for errors, review account types, ages, and payment history. Identify weaknesses, thin file, high utilization, or dormant accounts. Second, create a 12-month activation plan. Pay down balances and keep them low. Use old cards for small, recurring purchases and set up autopay. If your file is thin, consider adding a new line of credit, like a small personal loan you can pay off quickly. Execute this plan consistently for at least a year before applying. Third, maintain stability. Don't open or close accounts or take on new debt right before applying. Lenders value predictability above all else. Let your profile season and build a long track record. Quiet stability is your final proof of trustworthiness. Follow these steps, and you'll be ready for mortgage approval. Preparation is your best advantage. The path to homeownership can be confusing, but a mortgage denial isn't the end. It's a lesson. Your credit score is just the headline. Your financial history is the real story. By applying the trust formula, correct behavior, time, and diversity, you become the architect of your financial narrative. You're not just chasing a number, you're building a profile of reliability. Understanding what underwriters look for turns the process from a guessing game into a strategy. Now you can avoid hidden traps and present a compelling story of stability. This knowledge puts you in control. Mortgage approval isn't about perfection, it's about predictability. Build your profile methodically, and you'll leave no doubt in a lender's mind. The keys to your new home are within reach. Write your story with confidence.